And we're gonna be giving a personal finance and fintech workshop today. So yeah, let's get started. So just before we get into the workshop, a bit more about ourselves. So we're FLEO, which stands for Financial Literacy Education Organization, and we started when we realized 66% of Americans are financially illiterate, and this number kind of translates to across the world. 1 in 3 people know how to manage their money. So in this workshop, we have about 36 people. Mathematically speaking, that means only 12 of us would know how to manage our money, where the rest of us would have those basic skills. So our goal is to provide you guys the tools to be financially literate and financially stable. And we started after we realized that these core concepts that are universally recognized somehow are not being taught in schools. So our goal is to bring this financial content to you, give you a brief understanding, expose you to what financial literacy is, and at the end we'll also talk about some more resources where you can further your knowledge. Yeah, so let's get started.
All right, so compounding is an integral part of business and finance, which are both important in order to be economically self-sufficient. Compounding can work both for you or against you. Next slide. Okay, so let's start off by understanding what compounding is. Compounding, by definition, is the process in which an asset's earnings from either capital gains or interest are reinvested to generate additional earnings over time. Therefore, it is constructed with an interest rate in mind. Next slide. It is important to understand the differences between simple interest and compound interest. Simple interest only calculates your money from the original value, while compound interest calculates your value based on your most recent value. In easier words, simple interest only generates a specific value based on your original amount and the fixed interest rate, whereas compound interest adds an amount based on your most recent compounded value. So it would put an interest on top of a previous interest. An example of this is a famous math variable e, commonly seen in exponential graphs. Therefore, this allows you to increase your profits at a very fast rate. So how is this topic related to you in your everyday lives? Well, there are many applications where compounding is used. For example, in a benefit for a depositor who wants to deposit money into the bank, and commonly used in credit cards and student loans. So how do we calculate compound interest? Well, we use the formula seen on the screen where A equals the final amount, P is the starting amount, R is your interest rate written as a decimal point, N is the number of times the amount of compounded yearly. So annually would be 1, semi-annually 2, quarterly 4, monthly 12. And T is number of years you want the amount to be compounded. So with this equation, you can calculate different aspects of your compounding plan by just solving for a variable. Although compounding seems very beneficial for making profits, there are many downsides to it as well. A quote by Albert Einstein says, "This sums up the idea perfectly. Compound interest is the eighth wonder of the world. He who understands it earns it, he who doesn't pays it." Just like how profits can grow very fast, credit debt and other loans can grow rapidly as well. Credit card debt, if not paid immediately, could skyrocket just like your profits. With one mistake, you could be swimming in a pool of debt. One way to avoid this is to make sure you pay off all your debt quickly so you can avoid debt accumulation from compound interest. Next slide. So let's take a look at an example problem here. So it says if 3,000 is placed into an account with an interest rate of 5% and is compounded quarterly, how much is the account at the end of the 5 years? So for this one, you would just substitute all your known values. For example, P would be 3,000, R is 0.05, N is 4, and T is 5. And when you substitute that all into your equation, you get $3,846.11. Slide. Now for this one, it's a little different because you don't have your P value and you have to solve for the P, but you're given your A. So suppose you have a loan that is compounded for an interest rate of 6.9% over 10 years, and after 10 years you owe an amount of $100,000. How much did you put originally into the loan? So substituting all your numbers that you know and solving for P gets you $51,312.47. Compounding is an important part of being economically stable. If you compound successfully, it will make it will make it much easier for you to manage your money.
All right. So as you guys may be able to tell, this section is going to be focused on banking and money management. So what are the goals of this lesson? The goals of this part is to enable viewers and students to create a plan using the tools I provide in order to save up money and allocate it for future use. But ultimately, the main goal of this lesson is to teach viewers and students to become financially smart and responsible. So what is money management? Just ask, what is it? So when you search up the definition of money management, you get money management is the process of expense tracking, investing, budgeting, banking, and evaluating one's taxes of one's money, which is also called investment management. Money management is a strategic technique to make money yield the highest interest output value for any amount spent. And so as high school students and young adults without much prior financial knowledge, this may be a bit hard to understand and fully comprehend the meaning of. So in reality, the definition of money management is the control of cash flow, and may also be referred to more narrowly as investment management or portfolio management. And it'll help you avoid a lot of financial problems like wrong investments or credit decisions and help you reach your financial goals. More importantly, it helps you avoid incurring too much debt in the future. So why now? Why am I stressing money management and banking so much right now when you're young adults with still so much financial problems to come in the future? Well, scientists estimate that 42% of the recent pandemic-induced layoffs will result in a permanent job loss. And the overall unemployment rate shot to 14.7% in April, the highest since scientists have been recording it. And with the second wave coming around, we can only expect these figures to worsen. This means that people will be losing their steady source of income that they heavily relied on, and will be forced to make financially educated decisions or risk heading into poverty. So the first tool I'm going to be giving you guys is balance sheets. It may look very complicated, but it's actually quite simple. It's just how many expenses you're having, your income, and your overall assets, as well as net profit. But as young adults, we're probably not using it that much because we're not having that many expenses. It's used a lot more in the corporate scene, as well as your family maybe using it to track whoever does your taxes, whoever tracks your overall spending and income, maybe using this to keep a good balance, as well as learn to allocate money for the future. On the other hand, a budgeting plan is something that you as a young adult can use in your day-to-day lives. It's focused on saving money rather than making records of cost and income. And you can use it to allocate money for each category ahead of time in order to save money and become financially smart. So now we'll be talking about debit and credit within accounts. This is going to be a term you're going to see tossed around a lot when you're using balance sheets in the future. Credit is what you spend just anywhere. Credit is basically spending or decrease of wealth within an account. So an example I put up here, buying groceries is a credit. And it's always on the right-hand side of charts. As you can see on the bottom, credit on the right-hand side. Debit, on the other hand, is an income or increase of wealth within the account. It's on the left-hand side of charts. An example I put up there, selling a chair for $35, that's debiting $35. So these two are very different from debit and credit cards, which I'll be presenting in the next slide, as you can see. So just quickly, let me ask a question. Has anyone here used debit cards or credit cards or knows the difference between them? You can just drop in chat if you'd like. Okay, so we have a few people who have used them. That's 2 people for sure out of 48, so not too many. All right. Well, debit cards and credit cards are very different from debit and credit when used in balance sheets. Debit cards use money directly from your bank account and use an interchange fees like credit cards. Interchange fees are transaction fees that allow the bank to make money off your spending. So just a small amount of money each time you use it. Debit cards are cheaper as you don't have to pay back money that has increased due to the rate provided by the bank. You also don't have to worry about paying back the money as you're only spending money from within your account. So you don't have to worry about future debt from the bank. Credit cards, on the other hand, are similar to taking a loan from the bank and paying it off. A big pro is that you have access to the bank's vast supply of wealth. but you have to worry about actually paying it back with the interest rate or risk heading into debt in the future. Credit cards allow you to also build your credit score for future loans or whatever it may be, taking a big house loan, car loan, anything. Credit cards can help with that. And one question we get a lot is, as a young adult, would you recommend a debit card or a credit card, as credit cards help you build your credit score? Credit cards, obviously, you can take them under your parents' name, and it's going to help you learn how to spend your money wisely when you get a credit card in the future. But you can't actually build your credit score under your own name until you're 18. So debit cards may be safer because you can control your spending ahead of time, and you can just stop binge spending or wasting money on items that you don't need. If you have any questions, you can put them in the chat. Otherwise, we'll head on to the next section.
Okay.
Oh, sorry, we have a question from Anshu. Which one is better overall, even when you're not a young adult? I believe as an adult, you see the cards your parents use. That is a credit card. Credit cards are a lot better when you get older because first, it just forces you to use good spending habits, and you learn how to manage your money a lot better. But on top of that, you build your credit score. So if you have a credit card, you never use it, financial firms are going to see that you don't actually spend money on it. It won't mean anything. They won't take it into account. But if you have a credit card, you spend money on it, and you pay back your loans or interest rate on time, financial firms will see that you are a trustworthy and responsible customer, and they will be willing to give you large amounts of money when you need to take a loan, whether it's for investment in a house, a car, or anything like that. Building a credit score is really good. And maybe wondering what's a credit score. Credit score is just a numerical value to measure how financially responsible you are, in a sense, paying back your credit card on time. So it ranges from 300 to 850, and if you can stay above 700, that's really good. That's where you want to aim. So to answer your question, ultimately, credit cards are better when you're older, just because it helps you build your credit score, and it just makes you look like a much better and more responsible customer. Yeah, no problem.
Okay, so our next topic is investment. So when it comes to financial literacy, investment is one of the most important topics, but it's also one of the most complicated ones. So when we look at how investment actually works, first of all, investment is defined as the act of allocating resources, which is usually money, with the expectation of generating an income or a profit. So there's many forms of investing. So there's many types, like investing into the economy through the stock market, or investing in a particular company through loans. What matters most to us today is usually investing in the economy, which is through the purchase of bonds or stocks through various funds. A bond is a certificate issued by the government or a public company promising to repay borrowed money at a fixed rate of interest. And a stock, on the other hand, is a security that represents the ownership of a fraction of a corporation. So these are two very different concepts, and we'll get into them more later. But essentially, a bond, it means that an organization that you issue it to owes you money later on. And alternatively, there's also mutual funds, which are professionally managed investment funds that pools your money from many different investors to purchase securities. These securities can vary based on the type of fund. Mutual funds can invest in stocks, bonds, cash, or other commodities. And some of these funds cover multiple categories in order to be more balanced. So here you can see a diagram of the various types of mutual funds. Even this rather large diagram doesn't really cover everything, so I'm pretty sure you can tell how complicated funds can be. So some important categories you might want to remember are index funds, target date funds, and exchange traded funds, or ETFs. Index funds are portfolios created to imitate a financial market, such as the S&P 500. They contain stocks from a bunch of different companies in the market index in order to mirror the performance of the economy as a whole. And I think some of you have questions. I'll answer them at the end. Target date funds are funds that rebalance asset class weights over time so that it begins to, like the stocks get bigger and bigger as they age. And then both index funds and target date funds are considered useful for retirement. So if you invest in them early on in your career, they can build up over time and be useful for you in retirement because they can compound over time. And exchange traded funds are like mutual funds, a collection of securities such as stocks. However, they differ in that ETFs are listed on stock exchanges and traded throughout the day, unlike mutual funds, which are traded once a day after the market's closed. So how safe is investment? As a rule of thumb, here's a diagram of the safety levels of various forms of investment. As you can see, individual stocks are the riskiest, but they also have the potential for the greatest reward. Alternatively, forms of investment such as savings accounts are the safest, but they comparatively have a very little reward. What you decide to invest in depends on your situation and your willingness to risk money, and that's a decision you have to make for yourself. So if you choose to invest in stocks, you'll also need to be able to read the history of a stock. Pictured here is Apple's stock chart for the past 5 years. The letters in the top left are what is known as a stock ticker, which is a symbol that represents the company essentially. And for Apple, this would be AAPL. This is essentially just a short form for the company. And then the white number in the top right is the current price of each stock, which here is listed to be $300 and $318.19. And the red number next to it is how much that number has changed since the last market closure. So in this in this application, the red means the stock has dropped that amount, while a green number would mean that it has gained that amount. In this case, it dropped $1.04 since the last market closure. And then the green line that you see is the trend line, which marks the price of each stock at a point of time and then graphs it across a period of time, in this case, 5 years. So as you can see, Apple stock has gradually had an upward trend in value over the past 5 years. And for Apple, this is a good thing, and for Apple's investors. So one thing to be careful of when you're looking at charts is knowing what time period you're looking at. A single day, week, or even month is not enough to tell you how a company has been performing some of the times. So in addition, don't be too worried by sudden drops or gains in the stocks. Like, many factors can affect the stock changes, such as changes in leadership, releases of new products, political events, and much more. So one example of this is the current COVID-19 pandemic, which has greatly dictated the course of the market for the past few months. So if you can, try to see why the prices have changed as such in this graph, and knowing this will help you to predict possible future changes. Next slide. Yeah, so pictured here is the Tesla stock over the past 5 years. So go ahead and give it a quick glance and try to see if you can understand its changes, what the general trend is, and what any reasons why the stock price behaved as such.
And while you guys are taking a quick glance, we can also address some of the questions now. So Jagger Daddy asks which of the three is a safer bet, and also which of the three best overall. So as for a safer bet, bonds are typically very safe because you can think of it like the government is taking a loan from you and they pay it back with an interest rate. And mutual funds are also considered safe because they're extremely diversified, meaning they have a lot of stocks from different industries. Therefore, even if one stock drops, the others can hold the rest of it up together. And for the three best overall, they're each good at different things. So if you want to make money fast, stocks are probably better. If you want money for retirement, bonds, mutual funds for long term are probably better. Then we have a question that says, is it safer to invest in NASDAQ or Forex? So that's a great question. So for those who don't know, Forex is basically investing in the foreign exchange market, which is like investing in currencies. So typically people invest in NASDAQ are more buy and hold traders, which means they invest in the stock market and they hold on to their money, whereas people who invest in forex are trying to capitalize off the volatility of the market. So that basically means forex is more volatile, which means there's more fluctuations. So if you invest at the right time, there's better chances of you making money faster. So if you're from a safety point of view, most people would consider Nasdaq the safer option. But if you want to make money faster, forex is a better option. And then another question is, how much is a big change? Like how many points? That's another great question. So there's no hard and fast rule on this because every stock price is different. It's hard to say, okay, this is a one. There's like a constant number, but it really depends on the stock price. So for example, we see at this point in time, Tesla stock is $825. If it drops like $100, that might be a relatively big drop. But if you look at Apple, which is $200, and it loses $100 or 100 points, it means much more. So it's all in relation to the share price. So when you're looking at when you're looking at the change, you have to consider the share price in general. There's no specific number of points. You've heard of I've heard of black markets in terms of investment. Can you explain what these things are exactly? I'm not sure about the black markets of investment. Given that it's a black market, it's typically probably illegal investing, but that's not something that I would recommend you want to learn too much about, just because that's not going to take you down a very good path. But if you would like an answer, I can do some research and get back to you. But
maybe referring to insider trading, I'm not sure.
Yeah, potentially.
But that's something illegal. It's basically where someone who works at the company releases info about some big event coming up that may cause the stock price to rise, and then you buy a large quantity of that specific stock, so you make a lot of money, but it's obviously illegal.
Yeah, and then going back to the question about NASDAQ versus Forex, Forex is typically done with smaller amounts of capital or you could say the amount of money you have. So general rule of thumb is Forex is usually for people who are investing like $10,000 and lower, and then investing in stocks can be done with that amount of money, but it's most profitable when you have capital which is like over 10 grand or even larger. And then I think we can move on with this Tesla stock. You can put in chat what you think, Yeah, you can put in chat why you think the Tesla stock has changed this way in recent years, this large uptrend and the large downtrend. You can put in chat what you think may have caused that.
And Ira, just to answer your question real quick, I just Googled it real quick. And a black market stock is basically investing in things that are not government sanctioned. So that essentially means investing in like drugs or firearms that the government doesn't have control over, which is kind of like done with the intention of not being caught. That's what a black market stock is essentially. So it's like illegal stuff, but because the government has no control over it, and it's like investing in drugs, firearms, and stuff like that. Go to Stocks app and click some of the buttons. If you go on the Stocks app, let me go on the Stocks app real quick and see.
Okay, so I don't know if anyone knows why the Tesla trend has looked like this so far, because no one's put in chat, but I'll basically go over it. So as you can see, after 2019, there's this large surge in the stock price, and this was mainly due to Tesla releasing information about their new Cybertruck, their new ATV, and their new semi-truck. So this largely caused the stock price to go up drastically. And then you can see there's also a large dip right after that in 2020, which is largely due to the COVID-19 pandemic, which affected pretty much the whole stock market, and then Tesla is obviously included in this. And I think we can go to the next slide. Yeah, so now that we've gone over the basic concepts of investment, we can start to see why it matters to you and why should you feel free to invest at all. So first of all, there's numerous ways to invest. There's probably a method that suits you the best for your personal needs. So people often have a misconception that investments for the rich elites with vast amounts of money to spend, and that's not true. It's flexible enough that anyone who wants to get involved in investment can get involved. And investment doesn't have to be a risky business if you don't want it to be, as long as you know what you're doing. And it's also a good way to get involved in the economy, because the economy essentially relies on investment and transactions in order to stay strong. So by getting involved, you can contribute to the overall stability of the economy. And you can also personally get involved with industries that matter to you, and your investments can help shape the future. In addition, investing early can provide long-term benefits, and planning for the future can be greatly impacted by your investment decisions early on.
And just to answer one question we have in the chat, so the 190 T, the 1.9 T the T stands for trillion. So essentially that's alluding to the market cap, and the market cap is basically, you could see like Apple's worth in a sense. So and you so 1.9 trillion is Apple's market cap. And the way you can think of market cap is all the shares times the share price. So say I'm selling FLEO stock, for example, and I'm selling them for $1 a piece, and there are 10 shares of FLEO stock. That would make FLEO's market cap $10. So that's what the T, and the T stands for trillion. If you see it's a B, it's billion, and M is million.
So, planning for the future. Next slide. So as we're probably similar in age, all of us here, probably going to college, thinking of college, or are in college. So a fact is that as many as 44.7 million Americans have student loan debt, according to a 2018 report by the Federal Reserve Bank of New York. Student loans are taken by students who are like not able to pay for their college completely and need like a little help from the bank. And keep in mind, like, as we talked before when we were talking about compounding, when students have loans, paying it back is the more important part, because that interest can rack up pretty easily. And then another way students try to pay for their colleges are to get scholarships. Scholarships are financial aid reward designed to help students pay for their undergraduate degree. There's like more than one way. There are like a lot of ways actually to get scholarship. You don't have to be like an ace, like a 5.0 student to get a scholarship in a college or something. They're private companies that do their own separate colleges, and they have their own separate requirements that you have to fill. And like one big thing while you're in college is saving money, because every dollar counts. Because if you take for example, you take a student loan, you got to pay it back. You need all the money you have or you can get to pay it back as soon as possible. Next. Planning for retirement. You might think that we're like too young to think about retirement right now. We have a lot of time or something, but planning for retirement is like one of the main things you focus on when you're working, actually. So like when you're working, you would probably get into like putting some amount of money from your paycheck to your 401k account. So a 401k plan is like sets aside money from your paycheck into a 401k account, and you basically invest, so like that money grows over time. So the idea is that the value of stocks and bonds you invest in hopefully go up over time. So like your 401k is growing. 401k is basically a long-term saving, which leads you to have multiple sources of income. And that doesn't mean working like 5 jobs or like other by other sources of income. I mean, like you invest, for example, you have money, you buy a property, that's an investment property, and the money you're getting for like renting it out or like when you sell it goes towards your 401k account. So it's like it can be a little confusing, but at the same time, like it is one of the very most important things you might do in your future. But you may ask, why is it so important? Well, it's important because you save money for your retirement, and it also provides you like benefits along the way. For example, some companies might offer incentives for putting money in your 401k account. And another large benefit is tax reduction. If you pay money into your 401k account, the IRA will grant you a tax reduction on your like adjusted gross income at the end of the year, which basically means like actually let me give you an example. So you make $100,000 this year and you put $20,000 into your 401k account. At the end of the year, you will only get taxed. You will only get taxed for the $80,000 that year you keep in your pocket and not put into your 401k account. So like all in all, like investing is not about like investing in the market. It's basically investing in your future.
All right, so we've kind of gone over a brief personal finance lesson, but given we are all at a hackathon, it's important to understand finance in combination with technology. So in this section, I'm going to be talking about fintech and an application to fintech. Next slide, please. So fintech, as the name suggests, is finance plus technology. Next slide, please. And let's talk briefly about what fintech is exactly. So this can often be complicated, so I'm gonna go a bit slow and give you guys some examples. And if you have any questions, please let me know in the chat. Okay, so the first thing, right? So fintech is the automation of financial services. So before we can understand that, we need to understand what a financial service is. So a financial service it involves a transaction of money or an economic amount, like a stock or a bond or something like that. So say I have $20, right? And I want to give Emolji $20 because he's been a good friend to me. If fintech wasn't around, I'd go to his house and I'd say, hey, here, Mo, here's $20. Thanks for being a good friend. But today we live in a day and age that I can pick up my phone and I can just Venmo him or PayPal him or Apple Pay him $20. And that automation of that financial service is what fintech essentially is. And you can see this, you can see fintech not just an example. $20 is a lot of money for a good friend. I mean, he's been a great friend to me. He's been a good friend. So there's a lot of examples of financial services. Online banking is one of them. For example, if you think of big banks like Wells Fargo or Bank of America, in olden days, if we want to like deposit money in our bank account again, we would have to go to the bank and talk to the teller at the bank and deposit the money. But now again, we can go on our phones to Bank of America's mobile app, Wells Fargo's control tower, and manage all our money, see our transaction history, access our checkings and savings account, all through our phone. Another thing, like I just said, payment services. Cryptocurrency is another one. Bitcoin, you might have heard of Bitcoin. It's a very famous cryptocurrency, probably the most famous one. And for those who don't know, cryptocurrency is essentially a decentralized, digitized currency, which basically means it doesn't exist in real life. It's all on the internet. So if you think of the US dollar, even though I can give you $20 through Apple Pay, there's like actual $20, like it's backed by paper currency. Or the US used to go by the gold standard, which would back currency with gold. But cryptocurrency is completely digital, and a lot of people like cryptocurrency because it's decentralized, like I mentioned. So that basically means that no one entity, corporation, or government completely controls it. Like for example, the U.S. dollar is controlled by the U.S. government. Not that the U.S. government would manipulate the U.S. dollar, but it has the power to do so, like inflate the currency or decrease the currency. So, but cryptocurrency is not subject to that because it's decentralized. And the fourth is a crowdfunding platform. And you can think of GoFundMe. GoFundMe is the most common one, but there are many of them available. And crowdfunding platforms, if you've gone on any nonprofit ever, they'd be like, hey, check out this GoFundMe link. Can you read about our organization and donate? And for a good example of GoFundMe, you can go to our website and find the FLEO GoFundMe. If you want to practice some fintech, you can contribute to our GoFundMe, which would be greatly appreciated. But yes, fintech is essentially all these processes that we would do in our daily lives. We just make that using technology to automate that. Next slide, please. So I'm gonna do a quick demo here, right? So in the chat, can everyone just spam companies that you use on a daily basis? Just spam companies. Apple, Google. Oh, okay. Amazon, Google, Mercedes-Benz. Nice flex, nice flex. Costco, Amazon. Okay, so I'm seeing a lot of Amazon, a lot of Google. So all these companies, whether we know Subaru, yep, that's a flex as well. Don't let anyone tell you otherwise. So a lot of companies, like we saw a lot of Google, a lot of Amazon in the chat. They all use fintech. If you think of YouTube's paid platform, that's the fact that you can pay online through Google. That's done through fintech. Then Amazon, the fact that you can use your credit card once and store your information on Amazon, that's done through fintech. And a great example that I don't think anyone mentioned, maybe because COVID we don't use Uber as much, but I think Uber is one of the most example. One of the best examples of a fintech company, purely because we think of Uber like this ride sharing service, right? You can use your phone, get into a cab, but the fact that we can get into this cab, get dropped off to the place we want to go, and leave the car without any financial exchange, and we pay the driver through our phone is completely done through fintech. So anywhere you see online payment, you can bet that fintech is a part of it. So fintech is a part of our daily lives, and it's also one of the fastest growing industries. And all big companies are incorporating fintech some way or another because it's just so useful to have payment online. And this rapid growth of this industry allows for opportunity. So if you are someone who is interested in potential career options or an entrepreneur looking for the next big thing, fintech is definitely a place to explore because it's moving so fast. There's so many opportunities for you to capitalize off of because there's new fintech technologies being implemented on a daily basis. And if you look at those images, if the fintech image, there's again another more examples of fintech in our daily lives. Next slide, please. So that's kind of the basis of what fintech is. But we're going to spend the rest of the time talking about an application of fintech, and this application is algorithmic trading. So quickly in the chat, does anyone know algo trading, heard of it, or anything? No? Okay, we got to know. Not really. Okay, so yeah, this is not an extremely common topic that a lot of people, not a lot of people know of algo trading, and especially how to algo trade. So next slide, please. So let's talk about what exactly algo trading is. So the word is algorithm trading, right? So that should give a big clue that you're using algorithms to trade stocks. So it's essentially the use of code to execute investment strategies. And to better understand algo trading, you need to know what a moving average is. Also, a moving average is a statistical tool that is a smooth indicator of stock trend based on past data points. Also, if you look on the right, we have GE stock here, and you can see like extremely volatile. It's fluctuating a lot. So the moving average is something you use in algo trading because you can think when you code, you use something. You need to measure something, right? To see you need to pass some input to determine what your output is. So oftentimes people use the moving average to see, okay, if the stock goes up, I can buy that many shares, right? So when we look at the moving average here, as you know in coding, it's extremely important to set your parameters in the sense that you want to make sure you have your thresholds right? You want to say if it exceeds this number and stays under this number, I'll do this, right? You want to have that ease. You want to have that convenience to do that with ease. So when you look at the moving average here, it's extremely volatile. So that means it's going up and down a certain number of points every day, and that makes it hard to use in code. But the moving average actually offers the smooth line. So if we see the line underneath the GE stock trend, that's the moving average. And the moving average has less fluctuation, so it's easier to use, but it also still encapsulates the trend of the stock. So if the stock has been increasing, it still represents that same value it's been increasing by, but it makes it easier to use while coding. And if the amount of days is smaller, then the moving average is more sensitive. So naturally, if we're looking at a 20-day moving average, the events of the day would have a bigger impact on the stock in the moving average. But if it was a 200-day event, something that happens today might not have as much of a significance in the grand scheme of things. Therefore, the moving average is less subject and less sensitive to the daily events. And an example that helps people kind of imagine algo trading better is if the 20-day moving average moves up by an X amount of points, then buy 50 shares. So anyone that knows programming, the first thing that should come to your head is an if statement, right? If it meets this criteria of this conditional statement, if the conditional statement is true, and in this case it's the moving average moving up by X amount of points, then the body of code will be written in such a way that it executes a buy order for 50 shares. So that's a very basic example of algo trading. You're using this code to make these trades and hopefully make you money. Next slide, please. So let's talk about some benefits of algo trading versus manual or discretionary trading. So manual or discretionary trading is basically an individual buying stocks on his own, so or her own. So I say I have I'm logging into my E-Trade account, right? And I say, okay, I want to buy Apple stock today. And I just go buy 100 shares of Apple stock. That's a manual trade. That's at my discretion. But algo trade is the algorithms making that decision based on what you write and what you factor in to your code. So the benefits of algo trading are, number one, it eliminates emotions and bias. So as humans, if you've taken AP Psych, you know that we're subject to a lot of cognitive biases, and we have a lot of preconceived notions about certain things, and that affects our decision making. So using code kind of doesn't allow that to interfere with our purely analytical decisions that we want to be purely logical and rational with. Secondly, it allows for constant monitoring, which basically means unless you're a day trader, who's someone who trades stock on a daily basis, you don't have the time to keep looking at the stock market the entire day. Whereas an algorithm always is looking at the stock market while it's open, or even when it's not open, if you make it in such a way. And what this allows, it saves you a lot of time. So you don't have to keep checking the stock market once your algorithm's up and running. And it also allows you to be more consistent in your investment strategy. Say my goal is to buy stocks if it increases by 10%. As a human, there's simply no way I can go buy every stock in the tech industry that goes up by 10%. But if my algorithm is programmed to do that, it'll detect that automatically and make those trades on my behalf. So my investment strategy is more consistent, and it has a higher chance of succeeding. And it also enables the back testing of strategies. And back testing is essentially when you check the effectiveness of a strategy through the use of historical data. So right now we're August 8th, 2020, right? And I'm writing an I'm writing some algo code, and I want to see if it's working. So if we're building a website or we're building a program, we'd have to write our own test code, right, to see if it's working. But with back testing, you can use August 2019 data, right? We can take our algorithm, simulate it against the August 2019 market, and you can see how it reacts. And because you already know the outcome, you can see if it was a good trade or not, and that's how you can determine if your code is good or not. So it's like basically free test code by using past data points. And I'm sure everyone knows how annoying creating your own test code is. So it's another benefit. And overall, the reduction of human error due to the reliance on code. As humans, we can make a lot of silly mistakes, like I said, that are impacted by things that shouldn't influence our decisions. But we're able to leverage our programming and our programming skills to make the maximum amount of money possible. So it's not man versus machine in a sense. It's about how man can kind of leverage machine to make the highest profit possible. Next slide, please. So there's two types of algorithms we're going to talk about. There's a lot of types of algorithms, but there are two main types that are most pertinent to us. So both of them are pretty self-explanatory. So profit seeking, obviously, like the name suggests, your goal is to make money, right? You're seeking profit. And examples of that are strategy-driven algorithms and predatory algorithms. Strategy-driven algorithms are basically algorithms like I was alluding to earlier. Say you want to buy stocks if they increase by 10%. That's a strategy. My strategy is if they increase by 10%, I'll buy the stock. But predatory algorithms, I'll get to that after this actually. So order filling algorithms are to buy small portions of a larger investment. And you do this because you don't want to move the market. So like you must have taken away from the investing section, the more people that invest in a stock, the higher the stock price goes up, right? So if you're buying, so say I want to have like a large investment, right? So say I'm the head of a hedge fund, right? And I have $1 million to invest in a company, right? And I choose Apple. So I want to invest $1 million into Apple, or let's say 1 million shares. I want to invest 1 million shares into Apple, right? And I have the financial capacity to do so. I could go I could go and just buy the million shares right away. There's nothing stopping me. But what that would do is 1 million shares is such a huge amount that would influence the Apple stock to go up, right? So it would increase the Apple stock for myself. So if I want to invest into Apple again in the future, I've driven the price up for myself. Therefore, in the long run, in a sense, I'm losing money. But if I write an order filling algorithm that says, okay, I have 1 million shares of Apple to buy, I want to buy 50 shares of Apple for the next how many every days, correct? What that allows me is that in those ensuing days, I'm making that same investment because 50 shares is a relatively small amount. It won't impact the Apple stock as a whole. So for 50 consecutive days, I'm continuing to buy Apple stock till the million is filled up. I'm actually saving money because I'm not increasing the stock price for myself. And to go back to a profit-seeking algorithm, we could talk about a predatory algorithm. So a lot of big firms like private equity firms, hedge funds, which basically, like Joshua mentioned, manage large amounts of money for their clients. When they want to buy these big transactions, they use order filling algorithms because what it allows them is, one, like I said, it saves them money, but two, also it doesn't give away their investment strategy, right? If somebody makes a big investment into Apple, you'll know that they're heavily invested into Apple, and Apple is somehow part of their strategy, and therefore people who are writing predatory algorithms can find out and capitalize off their strategy. So a predatory algorithm is essentially, I'm looking for people who are buying 50 shares of Apple every day with my predatory algorithm. And once I find that, okay, there's been 100 shares of Tesla every day, I'm going to heavily invest in Tesla. Because over time, even if you invest the 50 shares of Apple, the stock price will still go up, but it'll go up slowly. But people with the predatory algorithm will put a big amount of money in, so they'll make money in turn because they put that money because they've realized, okay, you're investing a lot of money per day. So any stock that has like a consecutive investment, predatory algorithms detect if they're written correctly, that is, and they invest in that, so they make money. So like you can imagine, like a predator, you're looking for something off to leech off of and make profits off somebody else's decisions. And examples of order filling algorithms are VWAP, TWAP, and time slice algorithms, and they're just 3 different implementations of how you can do it. So based on volume, based on time, stuff like that. If anyone has any questions, this is I understand that this is like pretty confusing. So if you have any questions on predatory algorithms or anything on the slide, I'd be happy to answer them. But till then, next slide, please. So let's talk about the steps to algo trading. So if you think of creating a website, the first thing you do is you either draw out how you want your design to look for your website, or you think of, okay, I want this here, this here, this here. So same thing with algo trading is the first thing you want to do is you want to formulate your strategy, which essentially means you have an idea of your investment strategy independent of the code, right? So forget the code. Your first goal is what is this investment strategy, and what am I going to do to make me money? Once you have that locked down, you can convert it to code. Once you convert it to code, you backtest, which again is using past data points to see if your code is working. Then you would implement risk management, which is basically protecting you from losing a lot of money. It's just like a backup. And examples are adding limits or stop losses. We don't need to talk. It's pretty complex, but essentially it's just to protect you from losing a lot of money. Then you could do something called paper trading or simulating with real life data, and there's no money involved in this. So this is like backtesting, but you're using the present day market. So it's like I'm using like fake money in a sense to see if my algorithm is working with the present day market. And sixth and finally, you start trading. Because money is involved, it's highly recommended to start slow, and then you can scale up depending on if it's working. And throughout the entire process, you want to test your code, and you want to optimize your code. So I'm sure every comp sci teacher or anyone who does comp sci told you want to test your code like always. And then you also want to optimize your code, which basically means you want to make your code run faster, and this can be done by utilizing less memory in your computer or reducing the amount of lines. And the reason you want to optimize your code, the reason you want to make your code as fast as possible is because the faster your code runs, the faster the trade is placed, right? So this is a great way to save a couple cents. And over time that adds up, of course. It doesn't compound, but it adds up. And it essentially allows you to save money and makes your code run faster. So if two people have the same idea, if my algorithm and Ryan's algorithm have the same idea, and my algorithm is faster than his, I could save like 1 cent, and he like something like that. So it's just good in the long run, considering the volume of trades you're going to be making. That it's just good to have it as fast as possible. Oh, next slide, please. So let's talk about some resources for algo trading. A lot of people see algo trading as this extremely fringe or niche idea that only a few people can do, or only people who are extremely in like big firms can do. But that's completely wrong, in the sense that algo trading is extremely common individually and among big firms. To put it in perspective, the 86% of the private equity market right now is reliant on algo trading. So that means, while they're of course private equity and finance experts, 86% of the whole private equity firms are using algo trading to maintain their portfolios. And the recommended language for algo trading is Python, but alternatives do include C++, C#, Java. And if you're familiar with any of the alternatives, picking up Python won't be too hard. They have a similar conceptually. And then resources for algo trading, like as in platforms you could use, include Quantopian, QuantConnect, QuantRocket, and these three all are Python based, and they all allow for back testing, which is actually really beneficial, because you can get that data sets, like I talked about, those data sets through the platform itself. You don't have to go like scour the internet for past data points. It's already available in the platform, so you can use that. And they also allow for live trading simulations. And live trading simulations is a great idea, just because you can win money. So obviously you're not investing any in these live trading simulations, but you can win money if you partake in them, because a lot of private equity firms and hedge funds, they have these competitions where people trade without real money. But if you come first place, or if your algorithm seems really strong, they can give you prizes, or they can buy your algorithm in some cases. So yeah, so those are the three recommended. And I think that pretty much brings us to the end. Next slide, please. I think, yeah, that should be it. If you have any questions about anything, I can look through the chat. I'm pretty sure some people had some questions. I'm not sure. Was there any question we didn't answer? If you could ask it again, or if there's any new questions you have on not just the fintech or algo trading section, on the whole slide, we'd be happy to answer. Oh, thank you. Appreciate that. Yeah, so we're gonna like keep it open for questions, but if you could go to the next slide, please. So just to talk briefly, oh, you're getting your first debit card soon? Yeah, that's a great idea. It's the right time to get it. Yeah, so if we're talking about some resource, can algorithmic trading be applied into the Forex market? That's a great question. I believe it can. I think there probably won't be as many platforms that enable you to do so. I mean, logically, yes, but like I said, and it would be much harder to algo trade with Forex, because like I mentioned earlier, Forex is more volatile. So it makes it harder to write good algorithms, but I'm pretty sure yes. But there aren't as many platforms. Just to talk about some resources real quick. So financial literacy is really important. If you didn't get it already, like I said, 52% of students want more financial literacy education, because schools just don't provide that information. And as a part of FLEO, we've had the privilege to teach workshops to students from 16 different countries, more than 3,000 students. And we actually have 5 continental teams based in North America, Europe, Asia Pacific, Oceania, and Africa. And we've seen that across these different continents, the problem is the same, that financial literacy is just a skill that a lot of people don't have. So we do have a lot of resources. So if you drop your email in the chat, we have like a Google Drive, a shared Google Drive that we share with anyone that's interested, and it has like budgeting plan templates, access to like more information, and what that actually allows is you can use those budgeting plan templates, and you can start planning your time now as practice, and enable yourself to go forward. There's also a lot of financial literacy courses that we recommend. Like personally, we work with Bank of America a lot, and we definitely recommend their course, Better Money Habits. It's a great course. I've done it myself. I'd recommend that personally. And again, there's a lot of great free courses, and if you guys take the right steps now, like I know like mainstream media and everyone doesn't like portray this as a serious thing, but like our generation like is on track to falling into the same trap. So it's really important for us if we could give you guys whatever we can. And if you're interested in joining FLEO, you don't have to be financially literate. We'd love to like have you join our team. Our website is FLEO, www.fleo.online. We have 30 members, like I said, globally. And if you'd like to join, we have many workshops like this. We have guest speakers. We have our newsletter that if you entered your email, we could add you to the mailing list if you'd like that. And we have that. We have that too. So yeah, overall, that brings us pretty much to the end. Thank you